Hi, welcome to Market in a Minute. Man, that hockey game on Sunday, how much fun was that? Jack Hughes, you are an all-American guy. Um, it really warms my heart to see that big victory we had and the excitement of our hockey team. USA, it was incredible. So the market's in this shoot first approach. Shoot first and then maybe do research second. So we are taking advantage of this somewhat stupid market, stupidity in the market currently. Muhammad Alarian made some comments that gave us a gift. So Muhammad Alarian is a good economist. I follow what he says. I am not sure he's really following what was going on with Blue Owl, but it gave us a nice opportunity in OTF, which is Blue Owl's technology BDC. I'm going to go through that in detail along with Grail. I think these are two really interesting ideas. Disclosures, please read through those when you have time. The market update. So fear is running through different sectors of the market, right? So it's clearly hitting AI companies. It's hitting um, the software companies in a big way, right? We all know that. So on Monday, it hit the credit card companies. I think that's rather bizarre. I think maybe unfortunately the credit card companies are going to be around for a long time, charging these fees. I don't see how you eliminate them. So I think there were some nice opportunities created by this. Now, here's the overall stock market. This is the S&P 500, right? So you can see it kind of losing its momentum here. It's kind of stuck in this trading range. It's below the 20 and 50-day moving average. I really don't like it when it breaks the 50-day. It's done this a number of times. It's held this support by the 100-day. We think the support level on the stock in the SP 500 is currently 6,800. So it's 68.37 currently. So it's got to hold this level. If it doesn't, I think we're going to see more downside. The cybersecurity stocks are surely are coming down in a big way. They're still expensive, but they sure look more interesting than what they were. These are core holdings. This is where you want to be for the next 10 or 20 years. So we're looking at some opportunities there as well. The tariffs, you know, tit for tat, right? Nothing changed. Okay, they outlawed the terrorists. They said they weren't legal, but he can put them on a different way. What was the point? So the stock market went up on Friday, went down on Monday. Nvidia reports on Wednesday. Okay, key report. Expectations for about 11 billion sequential growth. The previous quarter was 10.3 billion sequential growth. Now, if you remember, we talked about this, that when they reported 2 quarters ago, right, they reported 2.7 billion increase sequentially. That was a big disappointment. That was a miss. But they guided up for these next 2 quarters. So the 10 and 11 billion increases, it's already in the markets. So the expectations is high. It's already in the markets. We think the growth rate might be going back to this 4 to 5 billion sequential improvement per quarter. We'll have to see how the market reacts to that if that occurs. So again, the technicals losing momentum's got to hold the 6,800 on the S&P 500, and it's got to hold that somewhere around that 100-day, which is kind of where we are. Otherwise, we're going to see the market potentially go, maybe significantly lower. We've been looking for a 20% correction this year. I say correction because we ultimately think it's going to might be higher by the end of the year. Grail. Okay, if you follow us, you know we love Grail. Now, we did an extensive amount of work on what they reported. They reported the quarter, but they also reported a clinical trial that they conducted over in the UK, over 140 subjects. Okay, this is the weirdest trial that was created. This trial has nothing to do with their approval, but on that news, the stock dropped from over 100 now to roughly $42. This is a great buying opportunity, in my opinion. Do your own work. But here are the facts. So the UK trial, 140,000 subjects over a 3-year period. What they wanted to do is see the decline in stage 3 and 4 cancer patients. So they did the first testing start of year 1. Then they did the second testing start of year 2, and then as we started the year 3, they did the third testing. So as they went through the trial, they detected quite a number of stage 1 and stage 2s, and the net result was there was much lower stage 4. That's what you want. You want that diagnostic to work to keep that cancer patient out of that metastasizing stage of stage 4. Okay, but for whatever reason, the stage 3 didn't have any improvement. So what the company is doing is allowing the data to continue to permeate, continue to go. So go for another 6 to 12 months and see. Probably what will happen is there'll be much more stage 3 cancers than what was already reported as more time passes. So their testing clearly works. It's scientifically based. They pick up the DNA in your blood early stage. So if you're not getting this test, you should. Now, why wouldn't this impact their approval? Because they already did another trial. It's called Pathfinder 2, 35,000 patients. They showed 7 times the improvement over standard of care with really a very small number of false positives. So they issued the data along with some data from the NIH Gallery trial. Some of that data they issued it as well. And I think, so that data was issued to the FDA in January. Highly likely that is going to be more than enough to get the approval of this diagnostic. So what they were doing is trying to prove a negative in this UK study. That's really hard to do and really a bizarre thing to ask of a diagnostic company to do. So here's the next catalyst. They're going to go over more data. This data that they just came out with at ASCO, big cancer conference in Chicago in May. So they're going to go over more data, and I tell you, I think the likelihood of that data looking good is really, really high. So we think that there's probably a 90% probability of this diagnostic being approved. That's our best guess. Okay, that's just a guess. So here's kind of some analysis of what the stock could do. So we believe if it's approved, worst case, there's 2 million cancer patients per year increase annually, right? So we think that that there'll probably be at least 100 million patients, somewhere around 100 million patients tested per year. But say there's not only 10 million, and say the price is half of what they're currently charging. 10 million versus 100 million, and half, so instead of close to $1,000 per test, 500. That produces $5 billion in annual revenues. Okay, generally you put a 4 multiple on that sort of revenue stream. That's $20 billion market cap. Well, the stock's trading at $2 billion market cap. So you could, and they have $1 billion in cash. So you could see a 10x improvement in the stock over time, just on a worst case approval come January of next year. 10x upside. The worst case for this company is that it doesn't get approved and it goes down to the cash level they currently have. So it goes from roughly $42 a share down to $20 a share. So when I think about managing money, okay, if I got a stock that has 10x upside and 50% downside, would I be willing to put 5% into it? So I risk 2.5% to get a 50% return? Oh, hell yeah. And I might even put 10. Okay. So it depends on how my year is going. So I would risk that. And in fact, we own a good slug of this stock. We got into it at 15. That was the original purchase around there. That's our cost basis. Ran it to 110, now at 42. So if all goes well, you've got maybe 100 million people doing the diagnostic annually, and you get roughly 500 to $1,000 per test. You got 100 times upside in the stock. Here is how you go and hear the replay of their conference call. I highly recommend you do this. It's worth listening to. So do research, right? Don't shoot first and don't do any research. You can do the research and then shoot later. Okay, this is a really good call. It goes through in detail. I highly recommend you listen to it. Now, USAR, U.S. Rare Earth. So this came up Friday when the stock went down on the terrorists being eliminated. We're like, okay, the terrorists didn't get eliminated. They just got moved around a little bit. So rare earths are going to be really important. We want this as a strategic thing to, to fend off China if they ever cut us off again on batteries. So the Trump administration has put in, or they're putting in 1.6, I should say billion, in debt and equity into this company. 1.6 billion. So that's quite a bit. And they're doing around $17 a share. We think that on this news, it could run back to, it got up as high as $30 in January on this news. We think it could go back there. They report this week. They report on Thursday. And we think that they'll probably guide to somewhere around 250 million in revenues for 2027, and that should get the stock doubling on those numbers. So somewhat of a speculative play. This is early stage company. We kind of like it as a trade. Take a look at it. Maybe it fits your portfolio. So switching gears a little bit, I want to talk about Blue Owl Capital and Blue Owl Technology. So what happened with this is this was kind of the straw that broke the camel's back. Ilarion, good economist, as I mentioned, he said, is this a canary in the coal mine moment similar to August 2007? No, it's not. Not even close. If you follow the BDC space, which I have for decades, this is not even close. There's nothing similar about it. So I'm going to walk you through what happened here. So Blue Owl is a alternative asset manager. So they make loans to companies. They may buy private companies as well, buy positions in them. They manage about $300 billion. So this is a big company. So this is a blue chip company in this space. So there's been two issues. So one issue is that their BDCs make loans like other BDCs, make loans to software companies, and that the fear over software companies because of AI. So you have to peel the onion back a little bit and really understand if there's really any concern there. Our conclusion was no. The type of companies they lend to in their BDC, cybersecurity companies in Blue Owl Technology, which we'll talk about, they lend to cybersecurity companies. So we think that those are very unexposed to AI issues, and we don't see a big impact at all to these companies. And the fact that they're making loans, so they're not making stock bets, they're making loans, and 20% of their portfolio turns over every year. I think it's highly likely they're going to get their money back. So very safe, right? So the other issue is, this is a bigger issue that affects Blue Owl. So Blue Owl Capital Corp, there's a public BDC. Um, it has the symbol is OBDC. Okay, nice big company. They had a small BDC, private, called Blue Owl Capital Corp 2. What they want to do is simply merge the two together. So when the public BDC was trading at par or maybe a little higher, they wanted to move that money and the private company, those shareholders, into the public vehicle. It happens all the time, right? But the stock of the public company went down. So if they did that, it would have harmed the private investors in the private fund. So they said scrap that. What we're going to do is this, let you redeem 5% a year, 5% a month, and then you'll eventually get out. Then they said that's probably not a good idea either. Why don't we just sell off part of the portfolio now? So the portfolio size is 1.6 billion. They sold off 600 million like that. Lots of demand for it. There's a lot of capital wanting to buy these types of loans. So very, very liquid private market, scooped up in a heartbeat. So the 600 million was sold. I would expect them to come back and do this a couple more times to clean out all the loans they have on their books and give all their money back. So this is put a cloud over whatever Blue Owl is doing. So it's very misunderstood. Kind of feel sorry for the management. The management's very good at what they do, and they unfortunately they have a cloud over them, and I think it's going to dissipate. So the opportunity in this, sure, you could buy OWL or the OBDC, the public BDC, or you could buy something we like better, OTF. So this is a public BDC. It's focused on technology. It's been knocked down quite a bit as they're kind of going through this redemption phase. So what they did is they took this, instead of liquidating it, like Blue Owl Capital Corp is doing it, they just took it public. So they brought it public, and then the investors can sell off a portion of their shares every month, and it's slowly bleeding out. Well, it's knocked the crap out of the stock. So the stock's NAV is 17.33. It's down to $11.20. So to get back to the NAV, which it will over time, that's a 55% upside. 55% upside to just get back to the NAV. We see this all the time in the BDC space. When private companies come public, they allow their shareholders to sell. They've been locked up in it for 10 years. So a lot of those shareholders are going to sell. It depresses the stock way down. And then what happens is the management of those BDCs generally buy back the stock at a low level, which they're doing. They announced a $300 million share repurchase program. That should soak up a lot of the stock that's coming out. And they're about halfway or two-thirds of the way through in this lockup period, and those shares being sold or kept in the overall market. So here you have a high quality BDC focused on exciting areas in technology. They have a position in SpaceX. We think that's going to add to the NAV appreciation when that comes public. So the other issue for the company, and we think it's a very minor issue, is the 20% that they have in software is almost all in cybersecurity. So cybersecurity, maybe the stocks are highly valued, but cybersecurity is just going to grow. And keep in mind, these are just loans. So they don't have to be great growth companies that they're buying. Some are, but are invested in, but they're just loans. So they get their money back. And by the time AI could impact this group, might be 10 years down the road. These are loans that mature on a schedule of generally 5 years or less. Their portfolio matures about 20% a year, so there's very low risk to this book of business. They have one of the lowest write-off rates of all BDCs. It's extremely low. So we like this a lot. You get a 14% Dividend, 14%, because it trades so far below the NAV, should be about 9. And the company's buying back stock, and we get that appreciation. When the cloud lifts, that stock that stock should appreciate over time back to the NAV. So 14% plus the appreciation potential, that's really compelling. So BDCs go through these little mini cycles at times. Gosh, they're painful, but they're really profitable if you can catch them, at or close to the bottom. And I think we're about there in OTF. OTF is the symbol. So if you have any questions, ping me. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. Go over the PVG to see what we're offering there. Somebody last week asked a really insightful question. Was, we like Amazon. We like the ETF that's 2x Amazon. And the question was, is there any decay in that ETF with volatility? It could happen. So something you need to keep an eye on. We wrote a white paper on the subject. It's on our website. So if it's on the front page there, you can read that and understand the risk if you do buy levered ETFs. Thank you very much. Take care.